I blew up my account 3 times testing one strategy. 3 times. Same mistake, same result. And the crazy part? The strategy was actually good. The problem was never the strategy. Today I'm going to show you exactly what went wrong, and I'm going to show you what I changed to finally make it work. By the end of this video, you'll know the 3 things that silently destroy traders, even when they have a solid strategy. This is not about indicators. This is not about charts. This is about what goes on inside your head every single time you place a trade, because that is where most traders lose, and nobody talks about it honestly. Let's get into it. Let me tell you about Marcus. Marcus found a strategy that was working. 3 wins in a row, then 4, then 5. He started out risking 1% per trade. That was his rule. That was the plan. But after 5 straight wins, something shifted. He told himself, this strategy is unbeatable. I know how this works now. He bumped his risk to 3%, then 5. Then on trade number 8, he went in with 10% of his account because he was, quote, locked in. That trade lost, and it wiped out every single gain from the previous 7 wins. One trade, everything gone. Because he believed winning was a sign he couldn't lose. Why it happens. Here's what's going on inside Marcus's brain, and honestly, inside all of our brains when this happens. Winning feels like skill. Losing feels like bad luck. That is the natural human interpretation. So when Marcus wins 5 in a row, his brain tells him he figured it out. He's not just following a system anymore. He's a master of the system. This is called the illusion of control. You start believing your performance is about you, your instincts, your judgment, rather than about probability and discipline. And here's the dangerous part. The market doesn't care about your streak. A coin flip doesn't become more likely to be heads just because the last 5 flips were tails. The market doesn't owe you a loss after 5 wins. And it doesn't owe you a win after 5 losses either. But your brain doesn't accept that. Your brain wants patterns. Your brain wants to believe skill is compounding. So what happens? You increase size. You lower your guard. You take trades you normally wouldn't take. And then one bad trade reminds you that probability doesn't care about your confidence. The fix. The fix is not complicated, but it does require discipline to set it up before you're in a winning streak, because during the streak, you won't want to follow it. Write this rule down right now. Your risk per trade does not change based on recent results. If your rule is 1%, it is 1% on trade 1, and it is 1% on trade 50. Whether you just won 10 in a row or lost 10 in a row, the number stays the same. I know that sounds boring. Good. Boring is what keeps your account alive. The second part of this fix is keeping a short written note after every win. And in that note, you write, this win does not predict the next trade. That sounds simple, but reading your own handwriting after a win is a pattern interrupt. It breaks the momentum of overconfidence before it builds. Marcus came back after that blow-up. He rebuilt slowly. He kept the same 1% rule no matter what, and after 6 months, he was consistently profitable. Not because his strategy changed, because his behavior after wins changed. Ask yourself right now, after your last winning streak, did your position size stay exactly the same? If it didn't, this lesson is for you. Now let's talk about Rachel. Rachel is a disciplined trader on most days. She has a plan. She follows her rules. She respects her stops. But then, one Tuesday morning, she takes a trade. It sets up perfectly. All her criteria are met. She enters, and within 12 minutes, the market moves hard against her. Stop hit. Trade closed. $200 gone. Rachel stares at the screen. She watches the market move without her. She feels that burning sensation in her chest, the one that every trader knows, the one that makes you want to jump back in immediately. She takes another trade, not because it sets up, because she wants her money back. That trade loses too. She takes a third, bigger size this time. She tells herself she's being aggressive. She loses a third of her account in 40 minutes, all because of that first $200 loss. That's revenge trading, and it has destroyed more accounts than any bad strategy ever has. Why it happens. When you lose money, especially on a trade that looked right, something primal gets triggered. It's not just frustration, it's a threat response. Your brain processes a financial loss the same way it processes a physical threat. Your heart rate increases, your focus narrows, your ability to think clearly drops significantly. And here's what makes it worse. Your brain doesn't want to accept that the loss is final. It wants to reverse it. It wants to undo it. And since you can't actually undo a trade, the next best option your brain offers you is jump back in and win it back right now. That's not a strategy. That's an emotional reflex. And the market will punish emotional reflexes every single time. There's also something called the sunk cost mindset happening here. The money you lost feels like it's still connected to you, like it belongs to you and you can go get it back. But the money is gone. The market doesn't know your name. It doesn't hold your money. That trade is closed. Those funds belong to someone else now. Once you truly accept that, truly accept it, the urge to revenge trade weakens dramatically. The fix. The fix has two parts, one immediate, one long-term. The immediate fix is a rule called the one and done rule. If you hit your daily loss limit, which you should define before you trade, not after, you close your platform and you walk away. For the rest of the day. That's it. Computer off, phone down. Go outside if you have to. You don't reevaluate. You don't check if things have calmed down. You don't tell yourself you'll just watch but not trade. You close the platform, full stop. Because the version of you that's sitting there after a loss is not the same version of you that built your strategy. That version is emotional, reactive, and dangerous to your account. The long-term fix is redefining what a loss actually is. A loss on a valid setup is not a failure. A loss on a valid setup is the cost of doing business. Every professional trader takes losses. The traders who survive do so because their losses are planned and their winners are allowed to run. Rachel eventually wrote this on a sticky note and put it right above her monitor. A planned loss is a controlled loss. That note saved her account more than any indicator ever could. Here's the question you need to sit with. What does a loss feel like to you? Does it feel like a mistake? Does it feel personal? If yes, you need to reframe what a loss means before you ever place another trade. This one is subtle, and it might be the most dangerous of all three. Meet Daniel. Daniel is actually a pretty experienced trader. He has a solid strategy. He back-tested it. He forward-tested it. He has a clear entry, a clear stop, and a clear target. He enters a trade. The setup is good. Everything checks out. He sets his stop 50 points below entry and his target 100 points above. The trade moves in his direction. Good so far. It gets to 60 points in his favor, only 40 more to the target. And then the market pauses. It pulls back slightly. Nothing dramatic, just a small candle in the opposite direction. Daniel stares at that candle. He starts thinking, what if it reverses? I've got 60 points of profit right here. What if I just take it? He closes the trade early. He takes 60 instead of the planned 100. The market then moves straight to his original target, 100 points, without him. He does this over and over again across dozens of trades, always closing too early, always out of fear of giving back profits that aren't even his yet. And here's the math that kills him. His strategy works when he lets it play out. The risk to reward is 2 to 1. Meaning, even if he's only right 50% of the time, he makes money. But when he cuts winners to 60 and lets losers run to the full stop, his edge disappears completely. He turns a profitable strategy into a losing one just by not following his own plan. Why it happens. This one comes down to how the human brain weighs gains versus losses. Psychologists call it loss aversion. The pain of losing feels roughly twice as intense as the pleasure of winning the same amount. So if you're up 60 points, your brain is screaming at you to protect those 60 points, even at the cost of 40 more. On top of that, uncertainty is uncomfortable, and open trades are pure uncertainty. Every second that trade is open, your brain is calculating all the ways it could go wrong. That discomfort builds until the easiest solution is just to close the trade and end the discomfort. The problem is, close the trade and feel relief is a comfort response. It has nothing to do with the actual trade logic. The market doesn't care that you're uncomfortable, and your original target didn't just disappear because you're feeling anxious. There's also a confidence issue underneath this. When Daniel cuts his winners early, part of what's happening is that he doesn't fully trust his own strategy. He says he does, but his behavior says otherwise. Real confidence in a strategy means letting it do what it was built to do, including sitting through the uncomfortable in-between moments. The fix. The fix starts before you ever place the trade. Before you enter, write down 3 things: your entry, your stop, your target. Write them on paper or type them somewhere outside your trading platform. Then add one more line, and this is the important one. Write, I will not touch this trade until price reaches either the stop or the target. That commitment, made before the trade, is much harder to break than a commitment made in the middle of an uncomfortable moment. The second part of the fix is managing your screen time during a trade. Some traders close their chart entirely after entering. They check back once every hour. They remove the real-time emotional trigger of watching every tick. That's not laziness, that's discipline. If you've done your analysis before the trade, watching every candle during the trade adds 0 information and a huge amount of emotional noise. The third part is a performance audit. Every month, look at your closed trades and ask, what would the results have been if I had held every trade to the original target? If that number is dramatically higher than your actual results, you have a management problem, not a strategy problem. Fix the management. Daniel did this audit. He discovered that in one single month, he had cut winners early by an average of 40%. His strategy was profitable. His execution was making it break even. That audit changed how he traded permanently. So here's your honest question for this point. Think about your last 5 trades that hit your stop. Did any of them touch your target before they turned? And for your last 5 winners, did any of them go past your original target after you closed them? If you can't answer those questions, you need better records. Because your records will tell you everything your emotions are hiding. Alright, let's bring this together. We covered a lot today, but it all comes down to 3 things. Number 1, winning streaks are dangerous. Not because winning is bad, but because winning can trick you into breaking your own rules. Your risk stays the same no matter how good things feel. Write it down, stick to it, always. Number 2, revenge trading is one of the fastest ways to destroy an account. After a loss, your emotions are in charge, and your emotions don't know how to trade. Have a daily loss limit. Walk away when you hit it. No exceptions. The market will be there tomorrow. Your capital might not be if you stay. Number 3, closing trades early is silently killing your profitability. If your strategy has a target, let it hit the target. The discomfort you feel while holding is not a signal to exit. It's just your brain reacting to uncertainty. Let the trade breathe. Let your edge do its job. Here's the real takeaway. These 3 mistakes are not about strategy. They're not about indicators or patterns or market structure. They're about you, your reactions, your habits, your relationship with money and risk and uncertainty. The traders who make it long-term are not the ones with the best strategy. They are the ones who have the best control over themselves when the strategy is being tested. That's the real edge. And it's available to every single person watching this. It just takes work, honesty, and a willingness to look at your own behavior without making excuses. Marcus, Rachel, and Daniel are all still trading today. They all went through painful moments, but they came out on the other side because they were willing to look at what they were doing wrong and actually change it. You can do the same thing, starting today. If this video helped you, hit the subscribe button right now. I put out 1 video a week. Every single one is focused on the mental side of trading, because that's where the real work happens. And next week, I'm going to talk about something that almost nobody addresses. What happens to your trading when you're going through a difficult time outside the markets? Stress, pressure, life stuff, how it bleeds into your decisions without you even realizing it. That one might be the most important video I've ever made. I'll see you there.